All right, welcome. Today, we're doing a deep dive on a really fascinating and, frankly, complex global company. It's one of the world's biggest private airport operators, Corporación América Airports, ticker symbol CAAP. But before we get into the nitty-gritty, let's just start with the one big question you have to ask about this company. What if you could own a piece of a powerful, cash-generating monopoly, but that monopoly was located smack in the middle of an economic earthquake? Because really, that's the core story of CAP. Okay, so let's unpack this. To really get what CAP is all about, you first have to appreciate the quality of the business itself. We're talking about essential infrastructure, and it operates on what a lot of people call the toll booth model, which is just fantastic. I mean, think about it. CAP runs 52 airports across Latin America and Europe. It's basically impossible for a competitor to just show up and build a new airport next door. This is a business with what we call an incredibly powerful economic moat, and it's all locked in with these long-term government contracts. Every time a plane lands, every passenger that flies, well, CAP collects a fee. It's literally a toll booth for global travel. And how they make their money is this really interesting balanced mix. About 53% of it comes from these super stable regulated fees, landing fees, passenger charges, that kind of stuff. But the other 47%, that comes from higher margin commercial revenues. Think duty-free shops, restaurants, parking lots. It's this powerful combo of stability and growth potential. Now, the whole business is built on these things, concession agreements. And these are not your typical contracts. We're talking about exclusive rights to run an essential piece of infrastructure for decades, often with built-in protections against things like inflation. Just to give you an idea, CAP has its main Argentine concession locked in until 2038, and its Montevideo airport all the way until 2053. That gives you incredible long-term visibility. Okay, but here's where the story gets really complicated. You can have the best business model on the planet, but location is everything. And for CAO, its main location is both its biggest strength and, well, its biggest headache. And this is where you see the problem in just stark numbers. In 2024, a staggering 51.3%, more than half of the company's entire passenger traffic came through its airports in one single country, Argentina. When one place represents more than half your business, you are completely tied to its fate, for better or for worse. And Argentina isn't just any country. It's one of the most volatile economic places on Earth right now. We're talking about hyperinflation that shot past 200%, a currency that's constantly getting crushed, which just destroys your earnings when you convert them to US dollars, and just extreme political uncertainty. There's even a real risk that the government could just block the company from taking its cash out of the country. This is the economic earthquake we're talking about. So, is it hopeless? Well, not necessarily. From an investor's point of view, there are two pretty clear paths forward that could unlock a ton of value and, reduce this massive risk. Path number one is a straight-up bet on Argentina itself. The current government is trying these radical shock therapy economic reforms. Now, and it is a big if this actually works and Argentina's economy stabilizes and starts to grow, CAP's earnings would just explode upwards. It's got massive operating leverage. This is the high-risk, high-reward home run scenario. The second path is one the company actually has more control over. It's a very deliberate strategy to spend hundreds of millions of dollars on huge expansion projects outside of Argentina, especially in Europe. The whole goal here is to fundamentally rebalance where the money comes from and make the company way less dependent on the chaos in Argentina. And a perfect example is the total transformation of their airport in Florence, Italy. Just look at this. The project is going to extend the runway, which means for the first time, they'll be able to handle those super profitable long-haul international flights. They're expecting to more than triple the annual passenger capacity. This isn't just a small upgrade, it's an absolute game changer for one of their key European assets. And believe me, these are massive bets. It shows you just how serious management is about diversifying. They are pouring nearly €500 million into the Florence project alone. And that's not the only one. They're also planning a $425 million investment to massively expand their airport over in Armenia. You put these huge projects together, and they could totally reshape the company's risk profile over the next 5 to 7 years. So you've got this amazing story, right? A high-quality business model, but it's getting dragged down by this extreme country risk, but with clear ways to unlock value. So how does the stock market price a story like that? Let's take a look at the numbers.
Look, this is no secret on Wall Street. The market is completely aware of the earthquake happening in Argentina, and because of that, it has slapped a huge discount on CAP's stock price compared to its peers. The big question for any investor is that discount big enough?
And this table just shows you that discount in black and white. We're looking at a common valuation metric here, EV to EBITDA. You can kind of think of it like a price-to-earnings ratio for companies with debt. Now, look at this. Similar airport operators in a much more stable country like Mexico are trading for between 9 and 11.5 times their earnings. CAAP, it's trading for just 6.2 times. The market is clearly telling you it sees a whole lot more risk in CAAP. So, all of this sets up a classic investment debate. You've got really compelling, rational arguments for why this stock could be a huge winner, and equally compelling arguments for why it could be a total disaster. The bull case, the optimist's view, is pretty simple. Argentina's reforms work, the European projects get done without a hitch, and that huge valuation discount closes. If that happens, you're looking at a massive return. The bear case, the skeptic's view, is just as straightforward. Argentina's crisis gets even worse, trapping the company's cash, the big projects hit delays and cost overruns, and investors realize, hey, this stock was cheap for a very good reason.
And that brings us right back to the central question. There is absolutely no doubt that owning this monopoly means you are taking on the risk of that economic earthquake. It all boils down to this. As an investor, do you believe the deep discount the market is offering you today is enough compensation for taking on that undeniable risk? That's the decision you have to make.